to this week's Money Metals podcast, helping gold and silver investors during these turbulent times. Now, this week's market wrap with commentary and analysis from Money Metals Exchange, the company named Best Overall Precious Metals Dealer by Investopedia.
Welcome to this week's Market Wrap podcast. I'm Mike Gleason. Coming up in a moment, we have a special interview from our Money Metals CEO regarding the total pandemonium we've been seeing in the retail precious metals market over the past few months now. Appearing on Arcadia Economics, Stephen Gleason gives a rare insider glimpse into what's really going on with supply chains, investor flows, and much more in this broad, sweeping interview. So stick around for that, coming up right after this week's market update. And as a reminder, if you enjoyed this material, please do us a favor and like and subscribe to this podcast wherever you consume this content. It's really exciting watching those Olympic athletes trying to win those silver medals, eh? That's right, they're literally going for silver, not gold. The 2026 Olympic gold medal is formed of 500 grams of sterling silver, an alloy containing 92.5% by weight of silver and 7.5% by weight of other metals. Then they are coated with 6 grams of 24-karat gold. Silver medals are made from 500 grams of sterling silver, and bronze medals are, well, bronze. One thing is for certain. Winners of these Winter Olympic events are getting medals worth a heck of a lot more than what the summer athletes won in Paris in 2024. The melt value of a 2026 silver medal, and the silver content in a gold medal, is around $1,200 at the current spot price of silver of $78. And what was the melt value of a 2024 Olympic silver medal? At that time, around $535. Even with just 6 grams of gold, the melt value of a gold medal is significantly higher. At $5,000 an ounce, 6 grams of gold costs about $965. That makes the total value of the medal in a gold medal at $2,125. When athletes competed in Paris in the 2024 Summer Games, the price of gold was less than half of what it is today, at around $2,400 an ounce. Now imagine if those gold medals were made of solid gold. You would be talking about a medal worth more than $83,300. I guess that explains why they make the gold medal out of silver. According to Olympic records, medals of pure gold were only handed out twice, the first time during the St. Louis Games in 1904 and then during the London Games in 1908. The medals were much smaller back then, and the average price of gold in 1904 was a mere $18.96 per ounce. And what about those bronze medals? Bronze is an alloy of copper and zinc. Depending on the exact formulation of the metal, its melt value is about $4. Lesson: don't come in third. And another lesson: gold and silver are a good store of value. And finally here, before we get to this week's interview, let's take a look at the price action in the metals markets. Gold is regaining what it lost yesterday here today and is now in positive territory for the week and checks in at $5,034 an ounce, good for a 1.1% weekly advance. Silver, meanwhile, has seen a fair amount of volatility throughout the week again here, but on the whole, the white metal is little changed since last Friday's close. Spot silver currently comes in at $78.27 an ounce, off 0.6% with a few hours left of trading for the week. Platinum is closing the week on a nice upswing based on where it was a day or two ago, but the industrial metal is still down 1.2% to check in at $2,091. And finally, palladium is off 2.1% to trade at $1,685 as of this Friday midday recording. Well, now, for more on the recent action in metals, supply chain issues, and a whole lot more on the state of the retail bullion market, let's get right to this week's interview between Chris Marcus of Arcadia Economics and Money Metals CEO Stephen Gleason.
Welcome on in. Lots to talk about. And how are you today?
Hey, it was great to meet you finally in person. Obviously, we've been talking for years, and that was really cool. That was a great event there in New York, and yeah, that was eons ago. It was $60 up and $30 down ago, basically in silver. But yeah, exciting times in our market. As you said, I mean, last week we were already seeing levels that were frenetic and higher than we'd ever seen, and then Friday was just out of, just off the charts, just absolute pandemonium with that crazy drop. When, people, it's kind of scary if you look at that chart. But it's interesting, it's kind of scary until you think about like 3 weeks earlier, it was at that price, they came back down to. So we need to be patient and keep our expectations in check. But it's a volatile ride, and it's probably going to get even more volatile as we go along here.
That's pretty much what I have forecast. If someone asked me, well, what do you think the price of silver is going to be in the next 1 to 3 months? I don't know, somewhere between 40 and 200. Although certainly I think you can expect more volatility. I think that's safe to say. Here's a look at the long-term chart, which doesn't have the spike to 120 in there, although interesting when you see that, how do you respond? Because normally, if you take the name off and look at any chart like that, you might think a pullback could be coming, of which we certainly saw one. Yet, as you were describing, perhaps you could talk a little bit more about the people who came in and were buying. I would guess that it was largely existing gold and silver stackers, but were there new people? What could you share about? Uh,
Yeah. Well, I mean, honestly, the volatility really prompts people on all sides to take action. You have longtime holders that are selling, especially as we led up to that run up that we got up to 120 last Thursday. A lot of longtime holders were taking profits, not selling their position, not selling out, but taking some profits. And there's nothing wrong with that, of course. That's, nobody ever went broke taking a profit. That's a great thing to keep in mind. Um, so that we've had a lot of longtime holders selling and then also some adding to their positions. But really, the story I think of the last 45 days, 30 days has been the new people coming in and coming in ways, that are unsustainable, impossible for the industry to absorb. Because it's a very small industry. I mean, honestly, 1 to 2% of the American people own any gold or silver other than jewelry. Maybe they have an ETF share or mining stock in their account, but physical gold and silver is not something that is widely held, especially in larger amounts. And that's a lot of potential growth. So when you go from 2% to 4% or 3% or 5%, I mean, these are 50, 100% increases, unsustainable across the supply chain, across the dealer network, across the minting and wholesale network. And I mean, we've really started to see that acceleration of new blood coming in since probably mid-December. And I think that that's only going to continue. I think we're seeing that, on the correction, people that were watching the headlines, seeing that run up, suddenly saw, massive pullback and jumped in. And it was just complete pandemonium on Friday. And through the weekend, it was very, very busy. I mean, honestly, we are focusing on, we're not necessarily focusing on prospecting right now just because there's so much volume already that we just need to make sure we can handle the volume we have, serve our customers well, especially our longtime existing customers, make sure that we're on top of the fulfillment backlogs and the different, customer service issues that come up when you have this kind of volume, just processing all the inquiries and responding to people and all that stuff and hiring. So it's really intense, really intense. I mean, there's definitely a lot more out there, a lot of people coming in, and we're still seeing that this week.
Well, it's funny you mentioned that. I saw your one of your articles where you mentioned I think you've hired 50 people in the last month or so, and I was
Yeah,
thinking about
70,
you
but yeah.
set up to
Yeah, we need about
70.
50 more. We're going to run out of space at some point. I mean, it's incredible. It really is. Uh,
Okay.
I mean, we're a pretty big company already, but that's a lot of people to add quickly. And you talk about training, you talk about the specialized knowledge that is needed, for example, just, inventory, packing boxes is not too difficult, but there's other things like quality control, people selling to you. All of that has to be carefully examined, tested, checked before it can be put into inventory. Of course, on the sales side, the admin, there's a lot of complexity. So onboarding a lot of people quickly is difficult, and we're doing the best we can. I think we're doing pretty well with it, but yeah, it's sorry, I that was just jumping in there. Yeah, it's 70 and continuing.
You mentioned that inflation is high, which I think myself and most of the people watching this would probably agree with, but it's intriguing. We're seeing 80, $100, $120 silver, $5,000 gold. Before I would imagine, I don't think most people who are in the mainstream audience think inflation is a problem yet. And obviously, I mean, we look at onshoring and a million other things. It seems a good bet it will go higher, but we're seeing this before there's been the next inflation wave, before the debt has been addressed or let alone resolved. So it's like, and then on top of it, we have the Fed futures curve. They're pricing in two rate cuts, 225
Mm.
basis rate cuts over the next 2 years. While Trump just put in his guy, Kevin Warsh, who
Yeah.
the media somehow calculated was hawkish. Yet, what if he is taking rates down to that 1% level that Trump has said that's where he thinks they should be? So there's, even with this prices, still some big elephants coming quickly down the
Yeah.
road.
Yeah, there's a real disconnect. I think the inflation, of course, is higher than it's reported, but to have the Fed loosening in an inflationary boom of really a hard asset boom. I mean, that's part of the reason it's happening, honestly. It's not the only reason. Deglobalization is also impacting that. And so, there's just a lot of inflationary pressures building. It's remarkable for the Federal Reserve to be in a rate cutting cycle in this environment. But that's the system. I mean, the monetary system is to counteract. Basically, they're deathly afraid of inflation. They want to prop up asset prices, and they're successful at doing that, and they have the unlimited ability to do that. And the most important thing for them is to make sure the debt burden is manageable. And it's, obviously inflation is a benefit to the debtors. The biggest debtor of them all is the U.S. government, and so that's what you're going to get. It's basically negative real interest rates, and that's called financial repression. And it basically harms savers. It harms people who hold fixed obligation or fixed income, and it basically benefits debtors, and it benefits people that can hedge or know how to manage their personal affairs to basically harness that to their advantage. And central banks are doing that. They're de-dollarizing. People that own a home, they benefit. And it's not as liquid as gold, but it's another tangible asset that benefits from zeros being added to the currency. And so that's really the lifeboat, is you have to get out of fixed income and try to focus on getting some exposure to hard assets. And one of the greatest ones is gold and silver. And we're seeing now the world kind of awaken to that. I think it's mostly outside of the country as far as people that get it. Asia, a lot of this is being driven by physical demand in Asia, not just India, but of course China. And then central banks on the gold side who have been buying gold hand over fist for the last 3 years. So I think it's slowly kind of winding around, and the American people who've been misled by their financial advisors and Wall Street, which is so enamored with financial leverage and paper investments. I think things are kind of coming home to roost, and I think again, I think we're still real early in this.
Yeah, and I think my favorite part, I'm writing notes down. You're bringing up so many great topics, although I love what you said the government, their main priority is managing the debt, which not doing incredibly well with.
Yeah.
Although, Stefan, back to the retail level, I was hoping you could put this into perspective for people. It's not something they can easily look up somewhere, but I've been reading, talking with bullion dealers that over the past, I would say 3 years, maybe you could be more precise, but a lot of selling at what has been described to me as historic levels.
Hmm.
I know you said there's been a lot of two-way activity over the past couple of months, but could you maybe like go back a little bit in time when you started noticing increased selling
Yeah.
and bring us to now?
Yeah. So of course, COVID from 2020 to 2022 and early 2023, that was a very busy time in our market. A lot of new people coming in. You had the inflation, you had the government, you had martial law, you had World War III, the Russia invasion, all the worries of that kind of stuff. Um, so then they had the bank thing, the bank run, the regional bank crisis in early 2023. That was sort of the end of the really frenetic period in our retail market prior to the more recent, basically 6 months or 3 months. So basically late 2023 to mid 2025, it was slow on the buy side and it was picking up on the sell side, meaning people were seeing, and it started with gold because gold was really moving. Remember, it kind of pivoted around the time of the Ukraine war in 2022. and then started on an uptrend, and then it started accelerating 2024, 2025. So as gold was rising, we started seeing a lot more people selling gold that had long held it for a long time. And of course, it went, more than doubled in the last 2 years. So we saw a lot of gold selling back to retail, not as much silver until last year, 2025. And of course, once it took off from the 30s and started heading to 50 and to 100, it really picked up big time the last few months. So, we started buying a lot more silver from our customers. We're an online retailer, so we don't bear the brunt of the selling in the same way the local coin shops do. People tend to like to walk in, and even if they get paid less locally, they can walk out with their money right away. Otherwise, they have to ship it to someone like us, maybe get a little bit more, or they have it in a depository, sell it from the depository. But a lot of the local dealers had this massive sort of imbalance between what they were buying and what they were selling. And so that caused all these local guys had to flip to wholesalers. Some of it got sent off to refineries. Basically, that caused the whole premium structure to start falling and falling. And that's been a condition really for the last 2 years. Started, like I said, with gold, and then it kind of moved to both silver and gold. So, it was now just in the last 2 or 3 months that we really saw the retail buying pick up. So now and you still have the selling. So now you have a very active market on both sides. But it's really, we've seen a lot of dislocations in our market with backlogs at refineries in particular. And so like junk silver, for example, still just flooded the market. We're selling it for several dollars under spot at moneymetals.com right now. You can't get it refined at all. So it's not a great time to be selling junk silver if you're a long-term holder, because you're going to get quite a discount to spot in the current market. It's not 3/9 pure, and so it can't be transformed into other products that might be more able to be sold. So that's led to a big glut in the 90% silver right now, and the premium structure has really fallen. Even as retail demand has picked up, junk silver, at least at Money Metals, is still well below spot. So it's interesting things are happening. The refining situation has definitely impacted the local guys in particular, the scrap comminglers. They're having lots of trouble. Some refineries are just outright refusing to accept scrap, 90% silver, even 3/9 silver. Some of them aren't accepting that. And even if they do accept it, it will be months before you get paid. And that's really shut down the funding mechanism around a lot of these local dealers in particular. So it's really had a knock-on effect on bids and also just the liquidity of the small guys. So really, on the minted product, there's an outlet, and that's new buyers. And of course, those have now just suddenly come rushing in the last few weeks. So I think, you'll start seeing bid premiums start coming up. You're already seeing premiums on the buy side rise as well because of the higher demand, especially things like Silver Eagles, which is not really the thing people should be buying, but people do. So it's a very interesting market right now. And one of the other problems is there just isn't silver refining capacity in the US. So like 60% of it's in China, and there's a premium in China for silver. So some of the silver that's going into China is not going to come back out, because why would it? If there's a premium domestically over the spot price. And so, we do have some issues in our precious metal supply chain here in the US, particularly with lack of refining capacity. So that's something that maybe we'll see progress on as the deglobalization unfolds and people see the consequences of not having the capacity here, especially from a national security standpoint.
Yeah, you touched on a bunch of the items on my list here because I'd really like to get this in perspective for folks with what's happening, the refiners, especially where it's like you see secondary product has become its own market from the newly minted.
Right.
Although just to set that up, I had a bullion dealer on last week, and he mentioned one of the changes is now, I think he said the refiners aren't sending the payment, or there's a delay in the payment, but something where the cash flows now have stopped, which
Right.
doesn't mean much to most people in gold and silver, but if you're on the retail level, means a lot. And perhaps you could touch on that.
Yeah, so the way a refinery works typically is, so you have all these smaller comminglers of scrap, and then you have local coin shops, and there's certain things that they buy, particularly sterling silver or junk silver coins, things that are not pure silver. that need to be melted and refined in order to basically get the money out. And so they have relationships with refiners. And what the way it normally works is they send it off, and as soon as it arrives, the refinery will check it and maybe do some initial testing, and then they'll let them take an advance off of that metal before it's been refined. And then those parties, those businesses take those funds and continue their business model, which is to buy scrap or buy junk silver coins or whatever. Um, but when they're no longer able to get advances, which has now been rolled out by several large refineries, they essentially are being told, look, we may be willing to refine your stuff. And by the way, it's taking weeks or months longer than usual, particularly on silver. We may accept it, but you're going to have to finance it where we cannot pay you until the end because we've just, exceeded our available capacity to do that. And not only that, but it's not just about credit lines, but it's also about the lease market because a lot of refineries, in order to finance their metal in production and to be able to pay people those advances, they have been borrowing metal from the bullion banks. And all the dislocations that have been happening in the market with, the spread, between London and New York and China, and all of this has caused lease rates to rise, which means that now to borrow metal, if you're a refinery and that's how you finance your feedstock, well, now you're paying a much higher rate for that privilege, much higher than, say, an interest rate on a line of credit. And so there have been times where, and this happened big time in October, where the lease rate went to like 10, 20, 30 cents an ounce per day on silver, per day. So if you're borrowing metal and you're using a bullion bank lease, you were paying $3 or $1 an ounce over a weekend just to finance that metal. And so when you're a refinery and you're working on 1, 2, 3%, 4% margins to refine, to pay for all your machinery, to pay for the whole process, and you're having a financing cost of, 1% or 0.5% a day, I mean, the whole thing just shuts down. So, I mean, that's not the situation at this very moment with lease rates. But the point is that there's so much metal in the mechanism, there's so much backlog that the refineries simply cannot be people's banks. So if you want to get something refined, yeah, they might do it for you, but you're going to have to hold ownership of that metal through the process. And then at the end, when it's turned into something that actually can be sold on the global market, 4.9 silver, 3.9 silver, or 1,000-ounce bars or whatever, which is really the ultimate liquidity in the market is on those large 1,000-ounce bars, because that is the spot price, and that's the item that's transacted at that spot price. When you can actually get it by taking those bars and putting them into the exchanges. So if you're a little guy, you got to finance that for 2, 3, 4 months through the refining process. And most of them can't do that. And as a result, they can no longer go out and buy more scrap, or if they do, they have to pay even lower. And so you can see how this has a knock-on effect. But I'm not worried about the refineries myself. I know people that are impacted by that go, oh my gosh, there's a problem at the refineries. I think it's a problem that, has to do with the massive backlogs and the fact that there's all these little businesses that, that normally have been able to rely on their counterparties for the financing that they can't do themselves. So it's just a really interesting dynamic. And it's going to take some time to clear this out. And frankly, if the selling continues, especially if metals, silver and gold go back up again, as they already are, you might see another wave of this. So again, lack of capacity. And it's just a small door, and not everybody can go through that small door.
With the silver that's being sold back, how come the dealers aren't reselling more of that out? I hear the newly minted stuff is starting to get less available and the premiums are higher. So, I mean, if someone comes in and wants to buy the cheapest silver, why aren't they buying back the stuff that the refiners can't handle? And it seems like there's a backlog there. Why isn't more of that getting sent back out?
That's a good question. Well, I think the 90% silver coins, I think that's definitely true there. A lot of people are selling that. Not as many people are buying it. And you see that reflected in both the bids and the asks. As I mentioned, we're selling for $3 under spot right now, that
Wow.
stuff. And we'd like to, we probably will be dropping the price more because frankly, we have more of it coming in than we're selling out the front door. And I think the reason is because recently we see a lot of new investors coming in, and they do not get the whole idea of 90% silver. They want something new, they want something shiny. They don't understand, 90%. Well, does that mean it's not an ounce? Does that mean it's not pure? Well, yeah, it means it's not pure, but it's sold by the ounce, and the copper you get for free. So it's very complicated. Then the whole thing about, oh, well, this is a quarter. Why is it worth $30? It's just a quarter, whatever the calculation is. Well, maybe about $20. So by the way, that's really remarkable if you think about it. Well, how much is a quarter that's silver worth in silver? I mean, that's almost zero point 0.2 ounces. So that's what, $16, $17. So one quarter from 1965 is today worth $17. I mean, that's such a great example of the devaluation of our money unit that's occurred. But again, people don't get that product when they're a new customer for the most part. And so I think that that's impacted the market there. I don't know that the secondary market is not being sold. I mean, some of it is being reminted into new. Well, that's not entirely true. There are situations where like we will get a bunch of 10-ounce bars that come in, and they're not saleable necessarily. And most of the time when people sell us something back, it's in good shape, but you go through it very carefully and say, okay, these are secondary market. There's lots of dings on them, or they're dirty or whatever. These are like new or actually new, and so they get put in a different category. So sometimes the older stuff gets remelted and sent off to the mints, which, up until very recently were desperate for business. So they would even take 1-ounce rounds, if it was convenient for you, because they were happy to just get the volume, because so much selling was happening a few months ago that there was almost no need for mints to do anything. So I guess my point is some of that stuff that you're talking about ends up getting remelted and minted into new stuff. And then the 90% silver, you can't do that because it's not pure silver. You can't turn it into a 10-ounce bullion bar. And you can't get it refined very easily. So all you can really do is sell it for less and less under spot, or hold on to it long term if you're a dealer like us. So there's just lots of different twists and turns in this market right now. Everybody is dealing with volume, and challenges in different ways. It's also very exciting because it does mean the market is expanding. That's part of why this is happening.
Can someone in China who needs silver talk to the dealers, round up a bunch of these lots? Is it just too hard because of logistics? It's small amounts, or do you think we could see something like that where they do have the refining capacity?
Well, I could tell you that we're having discussions with counterparties in other parts of the world about refining silver, including the 90% coins. So
Wow.
I'll say that. I would not be surprised if we're sending very large amounts of those out of the country to be refined. Obviously, when you're dealing with counterparties around the world, there's new risks introduced there, right? So, it's a little harder to go see them. It's a little harder to understand their operations. Sometimes we would like to do a site visit first. So there's more friction, and particularly in that part of the world. Not only is it a long ways away, but it's, maybe doesn't ascribe to all the same legal norms that we're used to in the West, in the US. So there are risks, but yes, that is happening, and that will happen increasingly. I mean, I feel like there's kind of a sucking sound coming out of China for silver and other minerals. And not only are they scouring the globe, going that maybe that's part of the reason for the Don Roe doctrine, is to go push them out of South America, because this is in many ways a resource war developing, and China has been very strategic about going and directly locking up these resources and investing in these areas. But I think that with the premium in China that you see on things like silver, and the fact that 60% or something of the refining capacity is there for silver, you're going to see scrap. And I'm sure it's already happening, and I think it's going to increase if this premium, certainly it's going to draw in the metal, both for the refining services as well as the fact they get a premium when they sell it domestically. So yes, they're going to be drawing in metal. Here in the U.S. with the COMEX, I mean, there is definitely a big stockpile of metal on the COMEX. But yes, that can be cleaned out. There are scenarios. In the case of money metals, I'll just reveal that back in October, we were involved in sending several 100,000 ounces to Dubai for end users in India who were just absolutely pounding the table. I mentioned the 30 cents per ounce uh, financing cost for people that
Mhm.
were short metal or who were leasing metal. Well, we were hearing from people in Asia and India in particular who were like desperately needing metal, desperately, and they were paying this overnight financing cost. They were screaming, the extra 2 or 3 days it took, the depositories were backlogged, but the extra couple days that it took was costing them massive amounts, to just get it out and then to get it shipped. And they were flying it over there, which is unusual. You don't normally fly silver, but when the costs are so high of financing it, time is very valuable. So we sent about 15 pallets of 1,000 ounce bars to Dubai that were intended for India. And so it's absolutely doable, and that has been happening to an extent. The COMEX stocks are declining. They'd gone way up during that whole tariff thing early last year, where there was a premium in New York, and it pulled metal from London. So it was actually kind of overstocked there, or more highly stocked than it had been. That's now draining. It doesn't take much. I mean, what is it? The registered category has 100 million ounces. So, I mean, and there's about 400 million in the exchange. When there's these big dislocations, the financial incentive to pull metal from anywhere, including the COMEX, are quite high. So I'm honestly surprised that it hasn't happened more than it already has, frankly, here in the US. I'm surprised that a lot of it hasn't left already. I'm sure some has, but it could happen very quickly.
For people that are selling metal back right now, I've heard $15. There was some guy on Twitter telling everyone he couldn't sell less than 30% under spot. What is the market out there? What should people be roughly expecting to get so if they do need to
Yeah.
sell, they don't get themselves in trouble?
Yeah, well, the bids are not great, but they are coming up the last few days. We've already raised bids. We're going to raise them again. Silver Eagles, the bids are coming up probably to the $4 or $5 under spot range. Those will probably come up pretty fast here because of what's happening on the ask side. When you deal with bars and rounds, you're still looking at, 9, 10, 11, $12. But again, I think that, that was especially the case when silver was $120 an ounce a week ago. And now we're seeing those bids come up, particularly as you start seeing the lopsided, much more people buying than selling. And so now all of a sudden, the inventories are getting cleared out, and that allows the spreads to narrow, especially on the bid side. Those will come up. So junk silver, though, I got to tell you, I mean, wholesalers are now bidding like 19, 18, $17 under spot. So like a local coin shop is probably going to be not able to get you even $20 under spot on junk silver. But again, I think that's going to be a short-term scenario. So I just wouldn't really be selling right now, honestly, unless you need to. Let the spreads narrow, and maybe silver will come back up. So, but it's not as liquid as it has been. But the other thing to keep in mind though is um, the percentages. So, when $4 premium when silver was at $30, that's 13%, right? When a $6 premium, $8 premium, when silver's at 85, that's a lot. That's a lower percentage. So, what is that? 7%, 8%. So that's the other thing to keep in mind. And that's really the most important thing.
Wrapping up, can you just let folks know where they can find you?
Yeah, that's okay. Yeah. So Money Metals Exchange, we're one of the top three largest online dealers and depositories in the US. Been around since 2010, so 16 years. We are located in Idaho. We help customers all over the country and internationally, but we're mostly focused on US. Our depository is the largest depository outside of the New York Fed, at least in terms of being a Class 3 vault. It's twice the size of Fort Knox, 8,500 square feet, four massive vaults. We store, we buy, we sell. We even lend if you want to get a line of credit against your own gold or silver in our depository. If you have a business purpose, we're a lender. Interest rates are well under 10%. It's a revolving line of credit. It's not like a pawn shop type situation. It's very flexible. It's an accommodation. Not many people want to do that. That's certainly, fine. But you can't go to a bank and get a line of credit against your gold and silver. They don't know how to value it. They don't know how to store it. They don't know how to liquidate it. They hate it. That's the other thing. It's kryptonite for the bankers. So there's no way you can get this from a bank. But at Money Metals, you can get a line of credit against your own holdings in your segregated storage account if you want. It has to be for a business purpose, but so that eliminates a lot of potential borrowers. But anyway, we're happy to help.
You can't take it and lever up on AGQ options on margin.
Yeah, and we don't allow people to immediately buy gold and silver. That's not the purpose of the loan. I mean, obviously money is fungible, but it has to be a business purpose. A lot of real estate investors, small business people, family wealth offices, different types, but not to put a new roof on your house. But ultimately, that is an attractive option right now in the context of people who are sitting on a lot of capital gains. Because if you were to sell your gold and silver for liquidity, which you can do, and obviously they're liquid assets, but you incur a taxable event and potentially have to pay capital gains tax at this crazy 28% discriminatorily high capital gains tax rate. And so borrowing against your gold and silver to get liquidity is an attractive option for those people in that situation. And again, if they have a business purpose, and it has to be their metal, obviously, it has nothing to do with anyone else's metal. Your metal in a segregated container at Money Metals Depository in Idaho, and we can give you a line of credit secured by that.
Good stuff there, and I hope you enjoyed that interview. Certainly gave a good state of things on what we're seeing in the metals markets right now, and hopefully gave you a better picture. Well, that will do it for this week. Be sure to check back next Friday for our next weekly Market Wrap podcast. And to check out any of our audio programs, including our second podcast, the Money Metals Midweek Memo, just visit moneymetals.com/podcasts, or find them wherever you listen to your favorite podcasts. And as a big help to us, we would ask that you please like, subscribe, download, and rate our podcasts. Doing so helps us extend the reach of this material. Until next time, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a wonderful President's Day weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes. For answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds, call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by to answer your call during business hours, Monday through Saturday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.